YouTube family, what is good? Back with another video for you guys. Apologies on my appearance. My barber is away on holiday, man, so there's not much I can do about that. But I didn't want to leave it too long without providing you guys with some source that I know that you need. I want to talk about how to avoid taking bad trades, and I don't just mean by having a good risk to reward. I mean by understanding what market conditions you're actually trading in. It wasn't until I fully understood this that I got better at taking quality setups rather than just being in the market and engaging in price action for the sake of it. That is how you actually lead to losing money and going on a slump within your trading journey. So if you're tired of taking bad setups, this video is for you. You're going to learn the difference of when to actually engage and when to step away from the market. I've been giving away these secrets in my free community that I've started. Click the link in my description to get access. Oh, and don't forget to like and subscribe to my YouTube channel so I can keep bringing you content like this. Let's get into it. All right, guys. So today I'm going to be going through the charts for you to kind of understand the difference of when is favorable market conditions and when you kind of just want to step aside and have some alerts set and wait for the market to actually give you favorable conditions, right? Because if you're just trading, every day, or you're trading every single week with the mindset of the market is going to be trending, right? You're already in problems psychologically because you're not understanding that the market moves in cycles, okay? There's three things that the market does. It either trends, it either retraces, or it consolidates. Those are the three things that the market does. Trends, retraces, consolidates. Now, trend is obviously going to be in the direction of being bullish or bearish. That is the trend that the market is moving in overall. Retracing is going to be potentially making structure points, right? So if we're trending bullish, we're going to be going up. If we're retracing, this is the retracement leg. This is the retracement leg, right? Same as if we're bearish. If we're bearish, it's going to be trending downwards. We're trending down. We're then retracing or pulling back, whatever you refer to it as, right? That's normal, right? Or the market consolidates, right? Consolidates. Doesn't matter what direction it's consolidating in. You can get it where it's trending down and it's consolidating and then trends lower. You can get it where it's trending up, consolidates, trends higher, right? If you don't think that the market is going to be in a state of consolidation at any time, this is where you're going wrong, because that means that you're trading conditions that are not favorable. And if you're doing that, you're basically, forget risk to reward. It's not just about risk to reward. You're trading in markets which are undecisive or indecisive, excuse me, right? So if the market hasn't made its mind up, and there's no direction, you're going to be caught in that if you're trying to trade that. So I'm going to teach you a trick, right? And this is what helped me in terms of understand what the market is doing, right? Is that if you see the market consolidating, okay, I want you to put a box over the consolidation. Just put a box on it, okay? Now, when you put a box on it, you're going to understand where the lower the range is or the higher the range is. Yeah? You're going to understand the lower the range is here, the higher the range is here. Okay? What you're then going to understand is there is liquidity resting above here, and there's liquidity resting below this point here. Okay? So if it targets one direction first, right, and then targets the opposite direction, if you was trading inside of that condition, right, where it's just going up and going down, going up and going down, that's not favorable. You're not trading it when the market is actually trying to do something, right? You want to see the market come out of consolidation before you start thinking about trading it. Now, the reason I'm saying that is because from experience, this is when I was losing the most amount of trades. Yeah, because I'm trying to ride the trend up to make a new high, or I'm trying to pull, see a retracement come down. Let's say the market is bullish, we've made a new high, let's say that's happened.
I'm trying to ride the trend down, but the market isn't giving me that because it's consolidated. If you're inside of that, you're going to be frustrated time and time again. So when the market is like this, draw a box on the consolidation. So you know, okay, I can see it's going sideways. Now notice, right, after it takes out and breaks the consolidation is when it then goes and continues higher. Okay? It's very important that you understand that. Same thing happens again. We enter another range right here. Sorry, right here. From here to here, right? You've got the lower the range again. You've got the higher the range again. It targets the higher the range first, then it targets the low of the range first. It's really important you understand that. Yeah? Targets the low, even takes out some more liquidity right here. Okay? Then it starts going. So when the market is doing this, that's the time to observe, and that's the time to set alerts above and set alerts below, so that when it comes out of that, right, you're now potentially looking to see price start getting on its way. And it's not like it takes this out and then just continues straight away. That's not what it's doing. Yeah, you need to understand the market conditions that you're trying to engage in before you start thinking about just entering the market. Otherwise, you're not going to be able to decipher what is a good condition, what are good conditions to engage in, and what is a good condition to kind of stay put and wait in, right? Is the market giving you potential opportunities here? Yes, but that doesn't mean it's the opportunity you're looking for. It's really not, okay? So when the market's moving sideways, you can see liquidity is being captured before it starts really. Look at the volume increasing here. The volume only increases once people that were potentially trading in these areas are getting liquidated. Then it starts moving. Yeah? You want to be a part of the trending price action, not this. This is more profitable than this. Yeah, I don't even need to spell that out, right? So when you understand that, okay, same thing again here, right? Let's look at this one. This one's an even bigger consolidation, right? Big consolidation here. Yeah, big consolidation here. Low of the range, high of the range. Okay, it targets the high of the range, then it comes down and targets the lows of the range. So I don't want you to feel like, you know, it was consolidating, I should have just bought it, just continue going, right? Go and study, and I want you guys to really take a look. Every time the market's consolidating, go and study how many times the liquidity didn't get taken from both sides. You'll find it's very rare that both sides are left intact. Because otherwise, it's just easy pickings for those that can kind of just tag along. You know, I bought it here, I tagged along and it went up. Sometimes it manipulates in order to make people think different, right? To confuse them. Manipulation is just confusion. So if it manipulates and continues higher one way, right, and then goes down the opposite way, why would it want to do that if the trend is clearly bullish, by the way? But why does it want to do that first? Because it wants people to start thinking about it becoming a sell and it being in a sell condition now. Okay? And it's all to fool you. Right? It targets one way, it targets the opposite way, then it goes back and starts trending again. Right? So consolidative periods are not periods to trade. Right? They're the time to watch. They're the time to set an alert. Okay, cool. The alert goes off. Boom. Okay, it's taken out the top of the range. So now you could get rid of the box. The range is broken. Right? If you've got, you know, your liquidity level drawn up, you could be like, all right, cool. There's a liquidity level here. It's taken out the top of the liquidity level. You know that this is still outstanding though. So when it targets it, it shouldn't be surprising to you. Hopefully it's not surprising to you. Right? But it wasn't until I understood this that I stopped trading these type of conditions. Right? Trading these type of conditions where it's just in a box. Right? You want to see one side of the consolidation captured. Then you want to start being interested. I'm not saying as soon as it's captured, press buy or sell. But the structure, if you go and study this on a smaller time frame, and let me know in the comments if you want me to do a lesson on entries or smaller time frame confirmations, let me know in the comments, right? If you want that, I will do a video on that as well. Go and study inside here. This is a 4-hour time frame, but you want to study once we dipped here, what is occurring in the next 4, 8, 12 hours, right? What's happening? Because it's not flying away straight away. It's hanging around for you to notice what's going on. It's just, are you understanding what is going on? Yeah, same thing here. Once it dips down here, it takes a couple days to really start getting on its back. Yeah, so really understand that. And again, what we have right here, another consolidation, right? We have another consolidation. You got the lower the range, you've got the higher the range. But realistically, just by understanding market price action, is sideways. It's not really trending. Yes, it's going up. Yes, it's coming down. Yes, it's going up. Yes, it's coming down. It's not trending though. Right? It's not trending. It takes out the bottom of the range, right? And then if you look closely, you've got the structure shifting here. You've got 2 swing points here, and it shifts structure, meaning it comes above there. Okay? That's the confirmation to suggest this is getting back in tune to go higher. You don't need to enter straight away. You need confirmation to enter, right? Don't be in a rush to enter the market. You need the confirmation still. Okay? So then once that happens, once that occurs, it starts moving up. We get retests and then it goes. Okay? But if you're trading this, I'm telling you, anyone that says they're trading ranges and they understand it's going to go higher and go lower, it's nonsense. You don't know how high in the range it's going to go. You don't know if it's going to come down here, rebound, and go all the way up here. It's going to be frustrating, right? And I've traded it, and I've witnessed it, I've experienced it, I've done all of that, right? It's not favorable conditions, okay? And why I'm saying this is April 17th, 25, and this is May 12th. It doesn't break out of the range until the 12th of May. So all of this price action, right? Yes, it's moving, but it's not trending. That's when hopefully you've got another pair that you can look at. Hopefully you guys can trade more than one pair. Hopefully you're not just banking on a pair and it's consolidating, because all pairs consolidate. I don't care what is happening. I don't care if you trade majors, minors, indices. I don't care if you trade commodities, crypto. Everything consolidates at one point because they build liquidity in the market again. So when you're trading the range, you're trading in areas where the liquidity is being built. You're adding liquidity to those areas. Okay, you don't want to do that. You want to see people lose first. Hopefully people lose first, right? Because as we break out to the bottom of the range, people who trade break and retest and trade these things now think it's a sell. And all of this, they're looking for a retest. It doesn't do that, whatever, right? The high of the range was left untouched. So that should be your your thought process should be, this never got touched, it went to the bottom first. That should be your thought process, right? Main reason I'm saying that is because if you think about the trend, overall we're going higher. We've made a range, we've taken out the lows first, right? You want to buy, institutions want to buy low and then continue the trend. They don't want to buy it inside here, it's too high. So they manipulate the price. Okay, the market goes up. Yeah? You get another consolidation. So all of these, look how many times I've drawn boxes, right? Where we can see what's happening. This would have been the range here. Okay. We can see what's happening. Let me just move this here. Yeah. From here to here, boom. Comes down, boom. Makes a new high. We're inside the range, boom. Takes out the highs of the range. Then manipulates lower. Let me just draw it here. Manipulates lower. Right, takes out the lower of the range is broken, and then gets up out of there. Yeah, gets up out of there. This is where we are today. So all of these times, right, that you're trading unfavorable conditions, more times you're just trading the consolidation. You don't want to trade sideways movement. You want to trade upwards movement, or you want to trade the retracement. Right? Upwards movement, 1 second. Upwards movement. Excuse me, let's draw another one. Upwards movement, right? What's going to be better to trade? Or the retracement here, right? Retracement. What's going to be better to trade? This, or this, or this, right? This is going to give you more profit than this is going to give you. Day by day, it's not going to be as readable. It's not going to be easy, right? But if you understand what's occurring, right, you can position yourself to, to be in the trade a few days. If you're a day trader or you want to be a day trader, you need to get comfortable being in the trade more than a day. Positioning yourself to be like, yeah, my position's great, I'm going to be holding. Because there's going to be times, right, where the market breaks structure, shifts structure, pulls back down. You're going to be looking for entries in and around here. It's going to move up. The next day comes, right, you've already got your entry. You need to now hold for it to go up again. Then the next day comes, it pulls back a little bit, and then it goes again. So you've got to be comfortable in understanding that, okay, my entry is good. I need to now hold on to this. Now, these are the type of things that I'm dropping in my community. I'm giving everything away in my community for free, right? The link is in the description. There's so much in there. There's modules, there's free modules, everything is in there. If you're not a part of it, join it for free in my description, okay? The platform is School. The reason I chose School is because it's very user-friendly. Go and check it out. Telegram's cool. I still got a Telegram too. You can join that if you're more familiar with Telegram. It's just not going to be as in detailed as what I'm giving my community in School. Right? Because with Telegram as well, a lot of people, they could be in 5 Telegrams, 10 Telegrams. Okay? My School community, my free community on School is invite only. Okay? Meaning you can't join and just be a part. I don't think there's 10 different schools. There probably is, but I don't think people are on 10 different school platforms. Whereas Telegram, everyone's taking in so much different trading information, they don't know where to start. They don't know where to start. But until you realize if you're trading in unfavorable conditions, right, you're going to be solely focused on, is my risk to reward good? And that's only one half of the battle. Yes, your risk to reward needs to be good to profit and be whatever, right? But the conditions you're about to engage in, you really need to understand them. And another thing that a lot of traders that are learning the craft, and the questions that they often ask me is, what do you do when you don't have a trade? You need to establish other hobbies, like no trade routines, right? It could be journaling. It could be going back through the trades that you've taken. This doesn't, you don't have to engage in the market when you're doing these activities. Hopefully you are journaling, right? But you need to establish things outside of pressing the buttons. Pressing buy, pressing sell. There's other things you can do. You don't have to sit at the computer all day and stare at screens, right? Because maybe you're thinking something's going to happen. Okay, if the market is consolidating, you don't have a trade. Simple as, like, you don't have a trade. Wait for the market. Now, can you time how long the consolidation is going to be? No, it varies. Sometimes you get short ones here. This is also, you could put a box on this up here, right? The lower the range, higher the range. Okay, goes up, targets the highest, breaks down, right? Then we start coming down. So, no, you can't time how long those things are going to be, but you don't be so eager to risk money. That's what I always say. Don't be so eager to risk money. 2 of my students, right, that have recently done their one-to-one mentoring with me, they've gone on to get funded now. And it wasn't because of just the one-to-ones. It was after we completed the one-to-ones. It was what I was telling them in our recap sessions, right? Because I don't like to just get people through my mentorship and then just be like, yeah, off you go, like, see you later, thank you. And I don't do that. Like, if you're with me for life. Like, I'm gonna always provide support. If you've got a question, if there's something you're still stuck on, I'm always gonna provide that, because at the end of the day, your success is my success. Okay? But I also don't like when people are tripping up on certain things when it can be simplified. Trading is simple if you understand your strategy and understand your trading plan. really and truly. Okay, so I don't want to make this video too long-winded. Hopefully you guys have understood the basis of what consolidation markets look like when a market is not going nowhere, what a trending market is looking like, right, and what a retracement market is looking like, when you should engage, when you should step away. Okay, so please like and subscribe to my YouTube channel if you haven't already. Again, my free community, which is on the School platform, the link is in the description. And please leave a comment as well if there's anything specific you're struggling with that you want me to actually go over on the chart like I did just now. Okay, so yeah, I won't leave it too long in regards to bringing you guys the next video. Okay, I've got one lined up within the next few days. I'm going to release off the back of this as well. And let me know what different pieces of content you want. If you do find these type of sessions useful or you need more psychology, let me know in the comments which you prefer. Okay, and I'll see you guys on the next video. Thank you for watching the latest episode. If you like that, please like and subscribe to my YouTube channel for more content. I'll see you on the next video.